Hello, my dear students. Welcome back to our quick revision series. Today, we're going to tackle a chapter that I know can be a little tricky, admission of a partner. But trust me, don't you worry. By the end of this, you'll feel like you can solve any question. So let's get right into it. I know, the board exams are just around the corner, and the pressure is really on. But hey, what do I always tell you? Tension nahi lene ka. We're going to break this chapter down into such simple, easy pieces. You'll see. So just relax, grab your notebook, and let's master this thing together. All right, so first things first, we've got this big word, reconstitution. It sounds super complicated, right? But it's really not. Just imagine your business is like a cricket team. Now, what happens when a new player joins? Well, the whole team lineup changes, the batting order might shift, the entire plan gets a refresh. That's exactly what reconstitution is in a partnership. The old agreement is over and you make a new one. And this slide, well, it just says the same thing in textbook language. Think of it like this. You're doing a group project with your friends. Suddenly, a new person joins your group. You can't just keep going with the old plan, can you? Of course not. You all have to sit down, divide the work again, and make a new plan that includes the new member. That's all this is. The old agreement is out, a brand new one is in. Simple. Okay, let's get into our first major calculation. And listen closely because this is something you will definitely see in your exam. Calculating the new profit sharing ratio. It makes sense, right? A new friend has joined the business, so now everyone has to figure out, okay, how are we going to share the profits from now on? So the most important thing to get here is that the old partners, they can't keep their old profit shares. It's not possible. They have to give up a small piece of their profit pie to create a slice for the new partner. And our job, as the smart accountants we are, is to figure out the exact size of everyone's new slice of that pie. Okay, let's look at an example. It's much easier that way. So on the screen, you can see Anil and Vishal are partners, sharing profits 3:2. Now Sumit joins for a 1/5 share. So how do we find the new ratio? It's easy, just 2 steps. Step 1, let's just say the total profit of the firm is 1. If Sumit is taking his 1/5 share, how much is left over for Anil and Vishal? That's right, 1 minus 1/5, which is 4/5. Step 2. Now this remaining 4/5 share, it belongs to Anil and Vishal, and they'll share it in their old ratio, 3:2. So Anil's new share is 3/5 of 4/5, that's 12/25. Vishal's new share is 2/5 of 4/5, which is 8/25. And we already know Sumit's share is 1/5. To make all the bottoms the same, we'll write it as 5/25. So there you have it. The new profit sharing ratio is 12:8:5. See? Not so tough when you break it down. Now, this brings us to the next logical question. We know the old partners are giving up some of their profit, but how much exactly is each one giving up? This is called the sacrificing ratio. And let me tell you, understanding this is the absolute key to understanding Goodwill. The name says it all, doesn't it? It's the ratio of the sacrifice. Let's use my favorite example, the tiffin box. Imagine you and your friend are sharing your lunch, and a new friend comes along. You both give them a little bit of your food. The sacrificing ratio is just us figuring out who gave how much. Did you share more, or did your friend? That's all we're calculating here. And here it is, the magic formula for it. Honestly, it's one of the simplest formulas in all of accounts. All you do is take a partner's old share and subtract their new share. Whatever is left, that's what they sacrificed. Please remember this formula. It will make your life so much easier. Okay, time for a little quiz. Look at the question on your screen. A and B are partners, 3:1. C joins for 1/4 share. What's the sacrificing ratio? I'll give you a second to think. Got it? The answer is B, 3:1. And here's the pro tip for you. If the question is silent, if it doesn't say how the old partners are sacrificing, you just assume they are doing it in their old profit-sharing ratio. It's a great little shortcut for your MCQs. All right, let's move on to the next big one, the topic that I know confuses so many of you, Goodwill. What even is this thing? Why does a new partner have to pay for it? Let's figure out the Kimat, the price of a good reputation.
The absolute best way to understand Goodwill is to think about a famous old samosa shop in your city. You know the one. It's been there for 50 years. They sell one samosa for 50 rupees. And right next door, a new shop opens, selling samosas for just 20 rupees. But where's the big line? It's still at the old shop. Why? Because of its name, its reputation, its taste, that special something. That is Goodwill. It's the value of a good name that helps you earn extra profits.
And here you can see the formal definition. It's just a fancy textbook way of saying what we just talked about with our samosa shop.
The new partner pays for this goodwill because they get to enjoy this ready-made reputation from the very first day they join. They don't have to build it from scratch. So how do you put a number, a price, on this reputation? Well, one very common way is the average profits method. Look at this table. We've taken the profits for the last 5 years, we add them all up, and then we just divide by 5 to get the average. So our average profit is 4,38,600 rupees. Now we multiply this average profit by something called the number of years purchase. Don't worry, this number will always be given to you in the question. In this example, it's 4 years. So you just multiply, and the total value of the goodwill is over 17 lakh rupees.
Okay, now for the most important part of all, the accounting treatment. How do we actually record this goodwill in our account books? This is where you score the full marks, Bacho, so pay very, very close attention. There are just 2 simple journal entries you need to know. Let's look at the first one. When the new partner brings in cash for goodwill, what happens? The firm's bank account balance goes up. And we all know when an asset, like bank, increases, we debit it. So bank account is debited, and we credit a special temporary account called Premium for Goodwill account. That's it. Entry number 1 is done.
Now for the second and most important step. That money the new partner brought, it doesn't belong to the business. No, it's a special payment, a compensation for the old partners who sacrificed their share of the profit. So we immediately transfer that money from the Premium for Goodwill account to the capital accounts of the old partners. And in which ratio do we do this? Yes, you got it. In the sacrificing ratio we just learned how to calculate.
Okay, wow, we've covered a lot. So here is your final pro tip, a quick hack sheet so you can revise everything we learned in just a few seconds. You can even take a screenshot of this. It's perfect for that last-minute revision right before your exam. Let's just quickly go through these golden rules. 1. Reconstitution just means a new agreement. 2. The magic formula you can't forget. Sacrificing ratio is old share minus new share. 3. Goodwill is simply the compensation for that sacrifice. 4. When goodwill is brought in cash, you need those 2 journal entries. And 5. The most important rule of all. The goodwill premium is always, and I mean always, distributed in the sacrificing ratio. Not the old ratio, not the new ratio. Got it? Perfect.
And just like that, you now know all the main concepts for this chapter. I am so proud of how well you focused. I'm absolutely sure you are ready to solve any problem on admission that they throw at you. You've totally got this. The only thing left to do now is practice. Go on, solve as many questions as you can. All the very best.